Ever wonder how some investors make it look so easy? Like they have this crystal ball that lets them pick winners year after year. Well, today we're going to dive deep into the mind of one of the most famous investors ever, Warren Buffett. We're going to break down his 2022 letter to Berkshire Hathaway shareholders, and let me tell you, it's a lot more exciting than just reading a spreadsheet. Think of it kind of like a masterclass in investing, with some pretty interesting insights into how the American economy works. By the end of this deep dive, you'll understand how Buffett thinks about investing for the long term, the reasons behind Berkshire Hathaway's success, and this interesting concept that he calls the American tailwind. Oh, and we'll also get into Buffett's thoughts on federal taxes, and spoiler alert, he and Berkshire pay a lot. Okay, so first things first, you need to understand that Berkshire Hathaway isn't your typical Wall Street company. Buffett and his partner, Charlie Munger, aren't just messing around in the stock market. They're building a whole collection of businesses that they really believe in. They have two main ways of putting their money to work.
One way is buying entire companies, often trying to get 100% ownership. This gives them total control over how the company is run and who's in charge. It's like being the captain of a ship, not just someone along for the ride. And a big part of this is trust. Buffett puts a lot of faith in the CEOs he chooses, giving them a lot of freedom to do their thing. But, and here's the interesting part, Buffett is really honest about the fact that he hasn't always made the right choices. Not every business he's bought has been a huge winner. Some have been, well, let's just say, not so great. He blames this on something called creative destruction, which is just a natural part of how capitalism works. And when it comes to people doing bad things, there's absolutely no room for that at Berkshire. That's a hard rule. Okay, so their second strategy is a bit more familiar, buying stocks in public companies. But there's a key difference. They're not looking for quick wins. Think of it like planting a tree and watching it grow over many years, not just picking the fruit and running off. They're after companies that have strong, lasting qualities and, of course, leaders they can trust. This brings up the difference between being a stock picker and a business picker. Buffett stresses that he and Munger invest in businesses, not just random stocks. They believe that companies with good foundations will do well over time, even when the market is going crazy. Now, you might be thinking, okay, that sounds good, but how do you actually find these amazing companies? Well, even Buffett admits that the stock market can act a little crazy sometimes. Stock prices can go way too high or way too low, and often for reasons that just don't make sense. He even questions this idea of efficient markets, which is something economists love to talk about. In the real world, things are a lot messier than the textbooks make it seem. This brings us to a really important point. When Berkshire buys a whole company, they usually pay more than what it's worth at that moment, sometimes a lot more. But when it comes to the stock market, all that craziness with prices can actually create great chances to buy amazing businesses at a discount. That's where the real magic happens. Buffett really believes in being patient and letting your investments grow over time. He says a lot of Berkshire's success comes down to making a few really great decisions, maybe one every 5 years, and then letting this thing called compounding work its magic. Compounding is like a snowball effect where your gains just keep building on top of each other over many years. To show you how this works, he talks about two of their most famous investments, Coca-Cola and American Express. Get this, Berkshire started buying Coca-Cola stock back in 1994 and ended up with a huge chunk of the company, 400 million shares. How much did that cost them? A cool $1.3 billion. And even for Berkshire, that was a lot of money back then. Now that year, the dividend they got from Coke was $75 million. But by 2022, that same dividend had grown to $704 million. Every year, that payment just kept going up without fail. And the value of their Coke investment, it had ballooned to a massive $25 billion by the end of 2022. American Express is a similar story. Berkshire finished buying their shares in 1995, also for $1.3 billion. The yearly dividends from Amex have gone from $41 million to a whopping $302 million. And guess what? Their Amex investment was worth $22 billion by the end of 2022. This is exactly what Buffett means when he talks about finding a few incredible companies and sticking with them for decades. It's not about trying to time the market perfectly. It's about giving your investments time to grow. Now, to really get you thinking about the power of compounding, Buffett asks you to imagine something. What if, back in the 1990s, he had invested that $1.3 billion in something that didn't grow at all, like a super safe bond that just sat there year after year? By 2022, that investment wouldn't even be 1% of Berkshire's total worth, and it would be giving him the same tiny dividend year after year. The difference is huge. Here's the big takeaway, and this is Buffett talking directly to you. The weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders. And of course, it helps to start investing early and live a long, healthy life, just like Mr. Buffett himself.
Now, let's talk about how Berkshire Hathaway did in 2022. Was it a good year? Was it a bad year? Well, they had a record year when it comes to what Buffett calls operating earnings. This isn't the same as those typical GAAP earnings you usually hear about. Operating earnings, according to Buffett, are the profits that come from all of Berkshire's different businesses, not including any money they made or lost from their stock investments. And in 2022, those operating earnings reached an all-time high of $30.8 billion. Buffett is a big fan of focusing on operating earnings, and he says investors should do the same. Why? Because he thinks GAAP earnings, especially when you look at them every quarter or even every year, can be really misleading. They bounce around a lot because of changes in the stock market, so it's hard to get a clear idea of how the actual businesses are doing. It's like trying to measure the tide while there are waves crashing all around you. You need something more stable. He even includes a table in his letter that shows how much GAAP earnings can swing from one quarter to the next. For example, in the second quarter of 2022, Berkshire reported a GAAP loss of almost $44 billion, but by the fourth quarter, they had a GAAP profit of $18 billion. Those big swings make it really tough to see what's really going on. Remember how I mentioned that Buffett and Munger are like business collectors? Well, in 2022, they added another great business to their collection, Alleghany Corporation. Alleghany is an insurance company, and it was run by Joe Brandon, someone Buffett had worked with before. Buffett clearly admires Brandon for how well he understands the insurance business and how Berkshire works. So why was buying Alleghany so important? Well, it gave a big boost to Berkshire's insurance float, which is a crucial part of their success but often gets overlooked. Float, to put it simply, is the money that insurance companies have from the premiums they've collected but haven't paid out in claims yet. Think of it as a giant pile of cash that Berkshire gets to invest and potentially earn a return on, basically for free. With Alleghany on board, Berkshire's float grew to a massive $164 billion in 2022. And since Buffett and Munger are known for being very careful about the risks they take on in their insurance business, making sure they charge enough in premiums to cover potential losses, there's a good chance that a lot of this float will stay free for them to use over time. It's a really powerful tool. In fact, Buffett points out that Berkshire's insurance float has grown an amazing 8,000 times bigger since they bought their first property casualty insurer way back in 1967. He even encourages new shareholders to read the detailed explanation of float in his letter so they can really understand how important it is as a long-term asset for Berkshire. Now, aside from buying whole companies, Berkshire also buys back its own shares to make the remaining shares worth more. In 2022, they bought back 1.2% of the company's shares, and they also benefited when two of their biggest investments, Apple and American Express, did the same thing. Buffett explains why share buybacks are good using a simple example. Imagine you own part of a local car dealership with two other people, and one of them is the manager. If one of the owners who isn't involved in running the business decides to sell their part back to the company at a fair price, does anyone lose out? Of course not. The manager isn't taking advantage of the other owner, and the public isn't harmed either. Actually, everyone wins because they now own a bigger piece of the dealership. Buffett uses this example to argue against people who say that share buybacks are bad for shareholders or the economy. He says that when done right, at prices that increase the value of the company, buybacks are a win for everyone involved. But he's quick to point out that if a company pays too much for its own stock, the shareholders who stick around end up losing. In those cases, the only winners are the people who sold their shares and the investment bankers who made the deal happen and got their big fees. And Buffett doesn't hold back when talking about companies that use tricky accounting to make their earnings look better and pretend they're growing faster than they are. He calls this behavior disgusting and says it doesn't take any skill, just a strong desire to deceive people. Buffett sees this kind of dishonest accounting as a real stain on capitalism, and he has no tolerance for it. Now let's take a moment to appreciate how far Berkshire Hathaway has come for the last 58 years. It's been an incredible journey from being a struggling textile company in 1965 to becoming this huge conglomerate that owns parts of some of the biggest and most successful businesses in the world. And this is where Buffett's idea of the American tailwind really comes into play. He says that a lot of Berkshire's success is thanks to how dynamic and resilient the American economy is. He believes that the United States has this unique ability to overcome tough times and come up with new ideas, which creates great opportunities for companies like Berkshire to grow and do well. He even goes as far as to say, America would have done fine without Berkshire. The reverse is not true. End quote. To show you just how big and diverse Berkshire's holdings are, Buffett compares them to the roughly 5,000 public companies in the U.S. Remember those 128 companies that earned $3 billion or more in 2021? Well, Berkshire was the biggest owner in 8 of them: American Express, Bank of America, Chevron, Coca-Cola, HP Inc., Moody's, Occidental Petroleum, and Paramount Global. It's a pretty amazing group of companies, don't you think? And there's more. Berkshire also fully owns 2 massive businesses that would easily be in that $3 billion club if they were public: BNSF, a huge railroad network, and BH Energy, a major player in the energy sector. Together, these 10 companies, along with Berkshire's substantial insurance operations, make the company a big part of the American economy. Buffett wants shareholders to know that Berkshire will always have a huge pile of cash and U.S. Treasury bills. This way, they can handle anything that comes their way, whether it's a financial crisis, a global recession, or even a sudden surge in inflation. They'll also avoid any risky bets that could put their financial stability in jeopardy. And in the future, anyone who becomes CEO of Berkshire will have to invest a big chunk of their own money in Berkshire shares. This ensures that their interests are aligned with those of long-term shareholders. In short, Berkshire is built to last. But here's something you might find surprising. Buffett and Munger aren't just super successful investors, they also pay a lot in taxes to the federal government. You might be shocked to learn just how much. Over the 10 years leading up to 2021, the U.S. Treasury collected a massive $32.3 trillion in taxes. During that same time, Berkshire Hathaway paid a whopping $32 billion in corporate income taxes. That's almost exactly 0.1% of everything the Treasury brought in. Think about that for a second. If just 1,000 taxpayers paid as much as Berkshire, no other businesses or any of the 131 million households in the United States would have had to pay any federal income taxes at all. Let that sink in. To help you visualize these numbers, Buffett uses a clever analogy involving stacks of $100 bills. $1 million in $100 bills would be about chest high. $1 billion, that stack would be 3/4 of a mile tall. And $32 billion. That stack would be over 21 miles high, which is about 3 times higher than a commercial airplane flies. That's a lot of money. Now, Buffett acknowledges that the U.S. has built up some pretty big deficits over the past decade, but he's not one to make predictions about what will happen because of that. He firmly believes that trying to guess what will happen in the short term with the economy or the market is basically useless. His focus is on managing Berkshire for the long haul, making sure it keeps succeeding and can handle any economic challenges that come up. And here's a final thought from Buffett on taxes. At Berkshire, we hope and expect to pay much more in taxes during the next decade. We owe the country no less. America's dynamism has made a huge contribution to whatever success Berkshire has achieved, a contribution Berkshire will always need. He sees Berkshire's tax payments as a sign of their confidence in the American economy and their belief that it will continue to grow and prosper. Now, I know all this talk about business and finance can get a bit heavy, but don't worry, it's time to lighten things up a bit with some wisdom from Buffett's partner in crime, Charlie Munger. Charlie Munger is a legend in his own right, known for his sharp wit and his ability to explain complex ideas in simple, memorable ways. And Buffett clearly values Munger's partnership a lot, often relying on his unique perspective to challenge his own thinking and refine their investment strategies. In his letter, Buffett shares a collection of Munger's most insightful quotes, many of which come from a recent podcast interview. These quotes give us a glimpse into Munger's unconventional wisdom and offer valuable lessons not just for investors, but for life in general. Welcome back.
We were just talking about Warren Buffett's idea of the American tailwind, this underlying force that he believes has driven Berkshire Hathaway's success for so many years. Now, you might be thinking, isn't that just, patriotic optimism? But Buffett's perspective comes from a lot of experience. We're talking 80 years of investing. That's longer than most companies that even existed. He's seen it all. Wars, recessions, market crashes, everything you can imagine. And yet through all of that, he still firmly believes that America can adapt, innovate, and come out even stronger on the other side. He emphasizes that in all his time as an investor, there's never been a point where it made sense to bet against America in the long run. And he doubts any of us will ever see a time when that changes. That's a pretty strong statement, especially coming from someone with his kind of track record. So what exactly is it about this American tailwind that makes it so powerful?
Well, it comes down to a few key things. First, you've got that entrepreneurial spirit that's so deeply ingrained in American culture. We're a nation of innovators, of risk takers. We're always pushing the limits of what's possible. And that drive to create and build new things, well, that's a huge engine for economic growth. Second, we've got this incredibly flexible and adaptable economic system. Capitalism, even with its flaws, has proven to be a really effective way to allocate resources, reward innovation, and push progress forward. It allows for something economists call creative destruction, where old, inefficient businesses are replaced by new, more dynamic ones. Think about how companies like Amazon have risen, while traditional retail giants have struggled. That's creative destruction happening right in front of us. Third, America has a strong tradition of rule of law and protecting property rights. This creates a stable and predictable environment for businesses to operate in, and that in turn attracts investment and encourages long-term growth. And finally, we can't forget about the sheer size and diversity of the American consumer market. With over 330 million people and a highly developed economy, the U.S. offers a huge and lucrative market for businesses of all kinds. These factors, combined with that resilient American spirit and a belief in the future, create a strong tailwind that has benefited so many businesses, including, of course, Berkshire Hathaway. Now, it's important to acknowledge that this tailwind hasn't always been a smooth ride. There have been periods of economic turmoil, market crashes, and social unrest. But even during those tough times, Buffett has stayed optimistic. He sees these setbacks as temporary bumps in the road, not fundamental problems with the system. He believes that America can learn from its mistakes, adapt to new situations, and ultimately come out stronger and more resilient. It's that enduring faith in the American spirit that forms the foundation of his investment philosophy. So what does all this mean for you? Well, I think there are a few key takeaways from Buffett's letter that we can all apply to our own lives, whether we're experienced investors or just starting out. First, it's a good reminder that patience is really important, especially when it comes to investing and building wealth. Buffett's success is built on taking a long-term view, being willing to weather market ups and downs, and believing in the power of compounding. He's shown that time is the investor's best friend. By focusing on companies with strong fundamentals and letting your investments grow over decades, you can achieve some pretty amazing results. Second, Buffett's letter shows how important it is to stay informed and be adaptable. He and Munger are always learning, always evolving their thinking, and always adjusting their investment strategies as the world changes. They get that holding on to outdated beliefs can cost you a lot. They're not afraid to challenge their own assumptions and embrace new ideas. And third, Buffett's unwavering belief in the American tailwind is a powerful statement about the resilience and strength of the U.S. economy. Yes, there will always be challenges and setbacks, but he believes that America's entrepreneurial spirit, its adaptable economic system, and its strong foundation of rule of law and property rights will continue to create opportunities for growth and prosperity. Now, before we wrap up this part, I want to leave you with something Warren Buffett said to think about as you manage your own finances. He writes, "I've been investing for 80 years, more than 1/3 of our country's lifetime. Despite our citizens' penchant, almost enthusiasm for self-criticism and self-doubt, I have yet to see a time when it made sense to make a long-term bet against America. And I doubt very much that any reader of this letter will have a different experience in the future." It's a powerful reminder that even when things are uncertain and challenging, there are still reasons to be optimistic. And maybe, just maybe, if we all adopt a long-term perspective and believe in the power of human ingenuity, we can each tap into our own version of the American tailwind and achieve some pretty remarkable things ourselves. Welcome back to our deep dive into Warren Buffett's wisdom. You know, Buffett's annual shareholder meeting is not your typical corporate event. It's become this legendary thing in the investing world, almost like a pilgrimage for people who want to learn about finance. Buffett sees it as a family gathering, a chance for shareholders from all walks of life to get together, celebrate their investment at Berkshire, and hear directly from him and Charlie Munger. And he's not shy about promoting Berkshire's businesses during the meeting either. He talks about how, at the 2022 meeting, their See's Candies booth sold a whopping 11 tons of peanut brittle and chocolates. 11 tons. Can you imagine that? He even breaks it down, saying that See's was making about 10 sales every minute during the busiest times, bringing in over $400,000 in just 2 days. He jokes that he and Munger live so long because they love See's Candies so much. It's a good reminder that even when you're talking about billions and trillions, a little treat now and then is good for you. Speaking of Charlie Munger, Buffett always takes the opportunity to highlight their special relationship. He describes how Munger can often say in one sentence what takes Buffett a whole page to explain, and always with more wit and clarity. He shares one of Munger's favorite sayings: "If you keep making something more valuable, then some wise person is going to notice it and start buying." Okay. It's a simple but profound statement that reminds us to focus on creating real value instead of chasing quick profits. Buffett also tells a story about how Munger has this go-to phrase when they're thinking about a potential investment: "Warren, think more about it. You're smart, and I'm right." It's a funny little jab that shows the deep respect and trust these two investing giants have for each other. And Buffett admits that he always learns something from talking to Munger, even if it comes with some blunt humor.
He advises us to find our own very smart, high-grade partner, ideally someone a little older, and really listen to what they have to say. It's a testament to how valuable mentorship can be and the importance of having people around you who make you think differently. So, as we wrap up this deep dive into Warren Buffett's 2022 letter to Berkshire Hathaway shareholders, I hope you've learned something valuable about his approach to investing, his unwavering faith in the American economy, and his unique partnership with Charlie Munger. It's a good reminder that success in investing and in life often comes down to a few key things: patience, discipline, adaptability, learning from your mistakes, and believing in the possibility of growth and progress. And maybe most importantly, it's a reminder to never underestimate the power of a good laugh and a trusted partner to share the journey with. That's all for this deep dive.
We'll be back next time with a brand new topic and another exciting exploration of information. Until then, keep learning, keep asking questions, and keep exploring.